Phil Reece, Sales Manager, Homestead Funding.
How does a person decide whether they can afford to buy a house?
The best place to start is to talk to the lender that you're speaking with and bring them your credit, income, and work history, and let the lender help evaluate what you're capable of getting approved for. The three things that banks look for in order to get approval are assets, credit, and income. And all three of those have to be within certain parameters in order to get approval on a mortgage. The amount of debt or amount of income you have can dictate how much home you can be qualified for.
The Homes program is having, this weekend there's open houses, and the Homes program is having bankers there at the houses to do what they call pre-approval or pre-qualification. What is sort of the difference between those two things, and what is that process? What does pre-qualification mean?
Well, pre-qualification is when a loan originator or a representative from the bank who's in a sales capacity speaks directly with the consumer, and they evaluate their abilities and determine how much home they are qualified to purchase. That qualification is done by the person who directly speaks with the consumer. A pre-approval in the eyes of the banking department is when an underwriter who is a decision maker, the person who will infinitely approve their loan in a formal capacity, reviews their file and issues an approval. It's just subject to an actual street address.
Now, now does a person who has those do they get a piece of paper? I mean, how does that help? I mean, obviously it will help them know how much house they can afford, and so it tells them what kind of houses to look for. Is it an advantage when you're making negotiations about prices and so forth?
Yes, it's almost a requirement in the Capital District to have a pre-qualification letter. Most real estate agents and sellers will accept a pre-qualification letter from a reputable lender. Any of the lenders that are on the Homes program would be considered reputable lenders. If it happens to be a company that someone's never heard of before, or maybe some of the online companies, they may ask for a pre-approval to make sure that there's been a second review on that loan. However, the pre-qualification is really almost mandatory to make an offer in our market, because the seller wants to know before they take the house off the market that that person can really be qualified for that property.
What kind of information, if someone decides to go to the open house and try to get a pre-approval, what kind of information should they bring with them on Sunday?
The best thing to bring is just your basic work history, income, and credit information. I know that it's a little intrusive that we ask for such private things, but things like social security number and date of birth, which we keep confidential and very securely within our systems, are all necessary to pull the credit report. It's something we can do on site, and what that will allow us to do is review that person's abilities in real time to figure out if they're qualified for that home or maybe one of the other homes that we're showing this Sunday.
And then also finally, I guess there's different types of mortgages, loan processes, programs, and could you just really kind of briefly give an idea of the different types of buying scenarios that people might come into in terms of the types of houses, or whether you're a fixer-upper or so forth, and those types of different programs that they can get involved with to buy a house?
There are two distinct types of loan programs in the entire United States, and they're either private loans, which are conventional mortgages, or government-insured loans like FHA, VA, USDA. Those are all loans that are designed to allow a buyer to do something a little bit more creative. Maybe it's someone with a slightly distressed credit score, or not a lot of income in order to qualify, or they may need a loan that allows them to improve the home's current state by having a contractor come in with estimates and purchase the house and have one mortgage based on the sum of both numbers. Those are government loans. An FHA 203K would be an example of one of those rehabilitation loans. Conventional mortgages typically have the lowest costs in APR, and they're a little harder to qualify for. But that's someone who is buying a home in usually pretty decent condition to begin with. And again, that's going to give them the best terms if they come with the best qualifications.